I've got nothing against stock screeners. Sometimes I even use them. But every screener on the planet is wrong about this stock. It doesn't really matter which one we are going to use today, but let's just use, for example, the one by Seeking Alpha. You can adjust the filters. Let's say we are looking for companies with market capitalizations of less than $5 billion US. We are looking for smaller companies. We want companies that the market doesn't really like, with percentage of shares outstanding short over 10%. And also these companies should be profitable, they should have positive free cash flow, and the price to free cash flow ratio should be less than 15. You get a list of over 100 stocks, US stocks. Now we rearrange the stocks according to valuations. Which of these stocks does Seeking Alpha tell us has the worst valuations? And you see on top of the list, we have Spectrum Brands. Maybe they are right about the valuations. We need to find out. We need to dig deeper to see if really the valuations are that bad. You look at the company today, it has a market capitalization of 3.1 billion US dollars. And the long-term debt of the company is around the same, 3.1 billion US dollars. So let's say you're buying the company at 3.1 billion US dollars, the whole company today, you are actually also buying the debt of the company. So in a way, if we are going to look at enterprise values, should be around double that, because the cash position of the company is only 327 million US dollars. So maybe it really looks like it is overvalued, because you're paying 3.1 billion US dollars for only 300 million US dollars in cash and over 3 billion US dollars in debt. And the company has a negative tangible book value. So it is a company, if let's just look at the balance sheet like this, it seems that this company has in year 0 even negative intrinsic value. But all of this is wrong. And why? Is because these numbers are updated only after quarterly earnings. So we need to wait for the next quarterly earnings, and then they are going to update what's on the balance sheet and what's not on the balance sheet. But what happens if there is something very important? So let's say the company sold part of the business and they raised cash. This completely changes the balance sheet, but you have to wait for the next quarterly report for it to be updated on these websites. It doesn't make sense for you to wait for the next earnings to act. If something important is happening right now and this is a company you've been following, maybe it is time to act right now instead of waiting for everyone to get the news. Speaking about the news, I always tell you that stay away from it. Most of the news is noise. You need to stay away from noise when you're investing. But it's important to know what is happening if you're following a company. And to do that, you need to know how to filter the news. There's an interesting website which I use called CityFalcon. CityFalcon is today's video sponsor. You can put your portfolio there, your watch list, all the stocks you're looking at, and then filter the news in terms of what's more important for you, what you want to be given to you. This is something I use every day because I don't want to go and find the news about particular companies when these news are not important. So I want to focus on what's important, and CityFalcon helps me. If you use the coupon code Ishfaaq, you can have CityFalcon for 25% off for any subscription. I recommend you try it. This is something that I use. Coming back to Spectrum Brands, so on CityFalcon, if you're going to follow it there, you will see that recently they sold one of their business units. Actually, they sold the largest business unit, and they sold it for 4.3 billion US dollars. This is not something that investors should not know, because these are real numbers that the company have given us. These are SEC filings. But if you are an investor, you're not going to read all of this. You are just dependent on what's happening on some stock screener. You're not going to see all this information. That's why it is important when you're analyzing a company, you're following a company, to go and look at the real numbers on the financial statements of the company. And sometimes these financial statements can come before the quarterly earnings. So looking at this updated balance sheet of the company, you will see that they have 4.3 billion US dollars added in cash. But this is before taxes and fees. They still have to pay taxes on the sales that they made. So in total, it is expected that 3.6 billion US dollars will be the net cash that the company is going to make from this sale, which is pretty good, because you look at the current assets that was put for sale, it's only 1.8 billion US dollars. So according to the accounting principles, that business that they sold was worth only 1.8 billion US dollars, but they were able to sell it for 3.6 billion US dollars. Because these accounting principles, they are wrong. That's why I tell you to be careful with the numbers you see. They are wrong because every year they have to impair goodwill, they have to impair other assets. But if really it is a business which is growing, which is generating cash flow, assets are increasing, not decreasing. But this is accounting principles. So they were able to generate more cash that was initially on the current asset part of the balance sheet. And the cash position now is around $3.9 billion, which is bigger than the current market capitalization of the company. And they have more cash than debt. So if they want, they can repay all their debt. Of course, it will not be wise to repay all your debt like this, but they intend to repay $1.6 billion worth of debt. And looking at the debt that they are going to prioritize in repayment, you will see that most of these debts are the ones that are due in the short term. So the next big debt that is due is in 2026. So before 2026, the company is only paying interest on the debt. All are at fixed rate. So even if interest rates are increasing, the company is not paying more in interest. And they have till 2026 to do other things with the cash instead of repaying debt. They can of course repay the debt, they can refinance it if they want, but I don't think this will be necessary. Gradually they are going to repay the debt, but there are other things that they can do with the cash. Before we talk about the other things that they can do with the cash, maybe it's important to talk about the business. If you want to invest in a business, you should know what they do. So it is quite a diversified business, I would say. Spectrum Brands, because from the name itself, they own many brands. It used to be 4 segments, now it's only 3 because they sold their biggest segment. So why did they sell it and why they are attempting to sell another segment? The business segment that they recently sold was home improvement, and the one they are attempting to sell now is home and personal care. One of the brands that they have on this, for example, is Remington. They also have Black & Decker, which by the way, this is the brand of my microwave oven. They own so many brands, but why do they want to sell these brands? Actually, if you look at what they are trying to do, they are selling their biggest brands, the most important ones. But these are also the ones that are more correlated with the economy. So we have a recession, they are going to sell fewer microwaves. Maybe people are going to keep their microwaves for longer because they don't want to buy another appliance. And also these are very competitive. So they want to focus on 2 other business segments, home and garden and pet care. Because even if, let's say there's a recession, you're still going to take care of your pet or your garden. Or maybe you can attempt to put the pet in the garden. They are going to eat and produce the natural fertilizers. But most people are not going to do this. They are still going to take care of their pets, still going to take care of their gardens. It is less cyclical. The company overall, it has good cash flow generation. So it's not because net income is negative, this is because of impairment and all, but in terms of cash flow over the long term, the company has been generating great cash flow. In terms of management, this company, Spectrum Brands, has a great management. The CEO is actually a value investor. You go on his LinkedIn profile, you will see that he calls himself a hybrid value investor. Why does he say hybrid? It's because he wants to operate companies too. So what he does, it's not his first business. He acquires companies, buy brands, build them and then sell them, take profits and then move on to other things. This is what he has been doing. He's actively buying shares of the company, so he believes in the company. And if you're going to listen to the conference course, you will hear always words such as fundamentals, long term, and these are the types of people that we want as value investors working for us. So I'm very bullish on the management, what they want to do with the company. And over the long term, they have been doing great. After the pandemic, of course, things got a little complicated, but if you look at the long term, they have been doing great. Now that the company has an additional $3.6 billion in cash, they are going to use $1.6 billion to repay debt. They have $2 billion additional. What can they do with that? They can buy back shares, they can reinvest in the company. We are assuming that they are not going to sell the home and personal care business. They want to sell it, but it's not done yet. If they sell it, they raise more cash. But in terms of the current balance sheet that they have, they can buy back more shares. And with $2 billion, with a $3 billion company, there's a lot of shares that they can buy. Actually, the current plan is to buy $1 billion worth of shares. So around 30% of the company, around 1/3 of the company. And you look at the shares outstanding short, the float now is 25%. Much of the company is owned by insiders. So the float is quite low. And this company reminds me of another one a few years ago, GameStop. The company is heavily shorted. The liquidity is quite low. Of course, it's not going to be like GameStop, 100 bagger, 1,000 bagger. It's not going to be like this. That was once in a lifetime. But it is possible that this company has a short squeeze. I'm not betting on a short squeeze. It was always a bonus for me. But in terms of fundamentals, this company is really undervalued. It's not just in terms of how much cash flow they can generate in the future, but in terms of the balance sheet too. And you as a value investor, when you're analyzing a company, you should focus more on the balance sheet. Why? Because cash on the balance sheet, this is cash that is real. You don't have to discount the balance sheet, the cash on the balance sheet. This is real. But cash for the future, the company, let's say, is going to generate $150 million in free cash flow next year. This, you have to discount it because money today has more value than money in the future. Cash today has more value than cash in the future. So you have to discount future cash flows. But what's already on the balance sheet, you don't have to discount this cash. This is what I do for every company. I did that with Meta last year. I bought a company, made a huge profit. If you're interested, you can watch the video about Meta. Have a nice day and goodbye.